Welcome to Bloomberg Law on Demand. I'm Pacchia. We're taking a look at the capital market space today. We're joined by David Goldschmidt. He's a partner at Skadden's office based here in New York. David, thanks so much for coming in. Welcome.
My pleasure to be here, Lee. Thank you.
So I guess it's always best to define something before you discuss it. A lot of people have been wondering what falls under the umbrella of capital markets. What's under the CM space?
Sure. My son asks me that question all the time. Capital markets is the financial market's ability to raise money, either debt or equity, for companies to grow, to expand, to take over companies. Either it's IPOs, companies first listing on stock exchange and becoming public companies, high-yield debt offerings for companies who are below investment grade and accessing the capital markets, investment grade offerings, companies like IBM, Coca-Cola, investment grade, who go access the capital markets all the time in the debt capital markets, and follow-on equity offerings. It also includes the private placement market, where small growing companies seeking venture capital financing or private equity financing go and raise equity or debt through those markets. So it is a very, very big umbrella.
Right. So you guys have seen an awful lot of combat over the last 3 years.
Oh,
turbulent times.
It has been a very difficult period.
So when you jump back and look at what's happened in the last 3 years, what stands out? What are some of the biggest changes that you've seen in the day-to-day practice of capital markets law?
Sure. I guess prior to August of 2007, when the markets were completely, looking back now, we would say overheated, where companies were raising tremendous amount of money, valuations were getting extremely high. And August of 2007, the capital markets held back. There was an overheating, and it stopped. When you added to that the turmoil of the financial sector, with the defaults and Bear Stearns and Lehman Brothers, there was a genuine panic in 2008 and 2009. And I think those are the days that people remember. Those were very scary times for people in the capital markets business, because we were looking not only as valuations dropping, as stock market was dropping, but also the freezing of the markets. People were unwilling to lend, people were unwilling to buy, and when you have that, you have a drop in prices. And so there was a real panic in the market at that time. And with the help of the government, TARP and other, the markets were calm, and now are progressing, and we are emerging in a recovery out of this recession. It's a slow process, because I think the recession was very deep. But it is slow. We're in the slow recovery process.
So I would imagine there's a bit of a divergence between the subcategories of capital markets.
Sure.
Which ones have led us out of the downturn, and which ones are lagging?
Sure. You know, if one's going to look back in a couple of years to the recovery, they'll see that it's taken a very normal, logical progress. What we had first was companies fixing their balance sheets. You may have heard about people talking about the wall of debt and how people were going to be able to pay their debts as they come due and refinance that. And mostly in 2009, 2010, public companies, good public companies that were facing principal debt payments in the upcoming years, took advantage of the Fed easing monetary policy and the low interest rate environment and refinanced their debt. And what we saw in 2010 were a huge amount of debt raises from companies. Once they were able to do that, and people saw that their maturities were being pushed out to a normalized level, they re-equitized their balance sheet. A lot of companies went out and raised, especially in the financial services market, and especially in the real estate market, they went out, refinanced their balance sheet, built up a base. And now those companies are really poised, A, to go on a growth strategy, and B, weather any other storms, financial storms that may arise. So I think the third part of it now is the growth companies. We're seeing tech companies coming out. We're also seeing private equity companies who've taken their companies private in 2006, 2005, have done exactly what I said. They rebalanced the balance sheets, pushed out maturities, lowered the interest rates, and now are ready to take those companies public or sell them.
We were talking before about IPOs and developments in that space. We've talked about prospective IPO for Facebook. LinkedIn recently had an IPO. Changes on that front. What do you expect to develop in the IPO space in the next 12 months?
Well, I think the Skype transaction that was announced yesterday is a great indicator. What I think we're seeing in the first quarter, four of the largest IPOs globally were U.S. IPOs, and they were all private equity companies that were taken public, as I mentioned.
Is private equity going to continue to drive the IPO market?
No, I think it's out of the 32 IPOs that were done in the first quarter, 24 were either PE-based, private equity-based, or venture capital-based. So that is certainly a driver. And what you have now, which you didn't have in 2010, is that you now have a very robust M&A market. And as I said, Skype is a great example. Here is a company that filed its IPO. And when you file your IPO, you're really basically putting a very big for sale sign on your door. And that's exactly what has happened. Skype or Google decided that they wanted to preempt the market of Skype going public. And I'm sorry, not Google, Microsoft wanted to preempt the market and paid a hefty premium for Skype.
Something like 40%, I believe.
Yeah. I think it was double what Silver Lake bought from it, a year and a half ago, and so from Skype's perspective, they ran a dual track, and I think what you're going to find is most companies, whether they're PE based or they're venture capital based and they're a technology company or a plain old company going public, they're now going to say, okay, let's think about going public. This is a way of potential buyers looking at us, seeing our financial statements, seeing our disclosure, and we'll run a dual track. And I think that's what we're seeing a lot of, and I think we're going to see more of it as the markets investors get more comfortable that the recovery is really on its way.
Let's talk real estate for a moment.
Sure.
We're kind of switching gears here, but I imagine you do that a lot day to day. You work on a lot of REIT deals.
Yes.
What's happening in that space now? Real estate's been in a lot of trouble as of late. Not the best time to be in the sector, but are REITs operating independently? How are things going in that space?
Well, I think what the recession showed, that being a publicly traded REIT company has its distinct advantages. Many private real estate companies during the recession did not have access to capital. They couldn't rebalance the balance sheet. They couldn't push out the maturities. They couldn't get capital to make acquisitions, and they couldn't re-equitize their balance sheets. In the real estate, the REITs were able to do all of that. And one of the interesting things that happened in 2009, that every real estate company, whether they needed equity or not, went out and raised equity at prices where their CEOs sincerely thought that they were undervalued. But it was important for the market to see that these people were adding equity to their capital base. Almost invariably, those deals rose on the news of doing an equity raise where you would expect the price to drop because of dilution. And the prices recovered substantially. Similarly, they went out and raised debt. And so those public REIT companies are now very poised to take advantage of portfolio of properties that are coming on the market. We are seeing a lot of interest in all sectors, and particularly the healthcare sector. We're seeing a lot of companies looking at portfolios, and a lot of private companies, family companies, who have weathered the storm, recognize that they need to go public and are thinking about going through the process. Real estate companies going public take a very long time to do. And so lots of them are thinking about it. So, the REIT sector as a overall sector, investment sector for the quarter has done very well.
Before we hopped on and turned the cameras on, we were talking about potential issues or problems that might upset the recovery as it's unfolded. What keeps you up at night?
I think, obviously it's the thing you don't expect. It's not seeing the economic data continuously improve. Everyone expects a little bit of blips. Job markets will go up and down. I think people are looking and hoping that Congress will tackle the deficit issues. I think people are always worried about terrorism and upsetting the financial markets and our way of life. So those are the things that bother us.
Did Dodd-Frank hit the mark?
Dodd-Frank it's still too early to tell. Dodd-Frank requires a lot of rulemaking. Most of those rules are required by the third quarter of this year. most of those deadlines will not be hit.
Right.
Lots of
It's a big bill. There's a lot of targets to hit. Yep.
A lot of agencies, and the government is taking their time trying to be thoughtful and not over-regulate. I think that's the most important thing for the U.S. government, is not to over-regulate. Government needs to regulate the capital markets. Shouldn't be over-regulating them, because we need to, for young companies to have access to capital. Mm-hmm. We want foreign companies to bring their companies to the U.S. to raise money, and we want foreign investors to invest and feel safe that their investments will be properly regulated.
All right, it's a fine line. It's certainly not an enviable task figuring all this out. David, we're going to leave it there for now, but I want to thank you for coming in. This was really interesting.
My pleasure. Thank you for having me.
That's David Goldschmidt. He's a partner at the law firm Skadden Arps, based here in New York City. If you'd like to learn more about the issues we just discussed, go check out our offerings on BloombergLaw.com and also on the Bloomberg Terminal. I'm Pacchia. Thanks for watching.